Good morning. Welcome to today's webinar, everybody. Thank you for joining us. I'm just going to give a moment for everything to come through. We might just get started and people are dropping in as we speak. So thank you very much for joining the webinar. My name is Jason Kennywell and I'm the Investment Director here at VentureCrowd. Today we're going to be talking about the early stage venture capital limited partnership, which has now become the most tax effective investment structure in the country. At VentureCrowd, we have over 80,000 registered members who have invested over $440 million with us across multiple asset classes. And we know that these changes to the CGT is now causing a widespread reorganisation of client portfolios. We also partner with funds managers to launch new venture capital funds and have deep experience in the establishment and operation of ESVCLPs in particular. Today's presentation will be delivered by VentureCrowd CEO Steve Maarbani. As you probably know, Steve is a former PwC venture capital partner who has acted in the establishment of VC funds for many of Australia's best known funds managers, so he knows the space very well. This briefing has been designed for wholesale investors, financial advisors, and asset allocators who are now reassessing their portfolios in light of the recent tax changes announced in the federal budget. But it will also be relevant to new funds managers looking to establish a new venture capital fund. Wherever you sit in that list, we'll give you an opportunity at the end to let us know what you'd like to know more about, and we'll pick up the conversation from there. I'm also recording today's session, so if you need to jump off early, or if you'd like to send this to someone who might be interested, the recording will be sent to you via email tomorrow. To kick us off, I'll hand over to Steve.
Thanks, Jace, and good morning to everybody who's joined us. Can I just check first that the sound is okay, Jace?
Yes.
Okay, cool. Before I get into the budget changes, I want to give you some background, which I think helps to contextualise this moment that we're in and everything else that I'm about to say. In 2007, I was a baby lawyer at PwC, and the federal government had just introduced a program called the Early Stage Venture Capital Limited Partnership. It was modelled on a similar global policy precedents in comparable markets, and it was designed to incentivise investment into the venture capital sector to help grow the pool of patient capital available to commercialise innovation by government pulling the most powerful lever federal government has to incentivise anybody to do anything, which is tax. And specifically, this was the first time there was a structure which recognised that one very material way to balance the risk associated with investing in the commercialisation of innovation, technology companies, startups, health tech companies and others, is to make the returns tax-free, which is basically what it did. And it was very clear to me at the time that this was one of the most important developments for the venture capital sector in Australia in decades, and that we as a firm should take it to market. So I spent months trying to get just one single partner at PwC to actually care about this issue. Now, the problem was that in 2007, venture capital in Australia was incredibly nascent. A handful of funds, no institutional allocation, no real track record worth mentioning. So walking into a partner's office at PwC and saying, we should be running roadshows about this new venture capital structure was essentially proposing that the firm spends time and money on what was then a niche of a niche. Anyway, eventually I found one tax partner willing to back the idea, probably because he felt sorry for the pain I was putting myself through. So we prepared a briefing. We had an audience of fund managers booked and ready to turn up at our Sydney offices. And my message to them was going to be super clear. This structure will become the preferred vehicle for venture capital investment in Australia. And that was scheduled to take place on the Thursday of the week that Lehman Brothers collapsed. September 2008, the peak of the GFC chaos, credit markets frozen, the financial system in genuine crisis. Needless to say, nobody was setting up new venture funds at that time or at any time afterwards in the near future after that. And I was a kid, really. I'd never really been through a market cycle at a professional level before. So for me, was a disaster. My career was essentially over. But here's the thing, and it's probably the single most important insight I can give you today. The technology sector didn't stop because of the GFC. In fact, While traditional financial systems were dealing with the consequences of the collapse, the companies that would go on to define the next decade, the SaaS businesses, the cloud infrastructure platforms, the mobile ecosystem, some of the best companies in the world today were being built at that time, quietly, steadily in the background, entirely unaffected by the shock that was crippling every other part of the economy. Airbnb, Uber, Dropbox, you've got some examples there. And these are just the ones that I think people might know quickly, but the list is actually quite considerable. All of these firms established and raised capital between 2007 and 2010. And when the dust settled on the GFC, as it always eventually does, investors who had sat on their hands were now desperate to invest in these businesses, desperate for venture capital style portfolio growth. And very quickly, the ESVCLP became the most popular venture capital vehicle in Australia. Now, historically, venture capital performance has always been at its peak immediately after a downturn in the traditional market. And this slide, which I've borrowed from our good friends at Aura Group, shows that clear as day. You can see here that returns hit their peak immediately after the dot-com downturn, immediately again after the GFC. Will history repeat itself now? A federal budget restructuring the CGT framework for entire generation has just been announced. We've got geopolitical uncertainty, we have tariff disruption, we've got Trump, we've got a global reorganisation of capital. This is a very familiar kind of confusion. And this time, it's not my first market cycle, and I guess it's probably not yours either. So here's my take on the moment we're in now. Underneath all of that noise, building quietly, as they always do, completely disconnected from the drama and the headlines and the sensationalism of the traditional markets right now, is the most consequential generation of technology companies in history. The next generation of corporate value in AI, in climate technology, in healthcare, in defence, in advanced manufacturing are all being built right now, and they are all private. These companies that you're looking at here are some of the companies that are currently in the VentureCrowd portfolio, either directly or through the City Angel Sidecar Fund. And they work on everything from long-range wireless communication, AI for the legal profession, portable cooling solutions for data centers, to literally curing cancer. Now, I don't expect you to have heard of any of these companies, but that's kind of my point. By the time most investors have heard about them, some major event is being reported in the AFR. And by then, it is too late to participate. By then, the real growth has already happened. The same dynamic that played out during the GFC is playing out right now. Capital that understands that and positions itself into the right structure will look back on this moment the same way the early ESVCLP investors looked back in 2009. So today we're going to cover exactly what the budget changed, why the ESVCLP is now unambiguously the most tax-effective investment structure available, and what that means for the reorganisation of every investment portfolio in the country. There's a lot to cover. I'm going to do the best I can in the time that we have. I expect you'll have questions at the end, but we'll give you an opportunity to connect with us later for anything I don't cover. So let's get straight into it. Before I get into the tax architecture, I want to spend a few minutes on something that I think gets missed in these kinds of conversations. The base case for venture capital, irrespective of the tax treatment. If you look at the portfolios that are managed by the most sophisticated allocators in the world, they will almost always have a significant allocation into private assets, somewhere between 35 and 45%, with venture capital playing a core role in those portfolios. And more now, we are beginning to see that kind of allocation language being used publicly by mainstream financial advisors. This is no longer a fringe set of people who are backing VC as part of their private asset allocation. And there are very good reasons for that. Firstly, the non-correlation of venture capital with traditional assets is the first. Early stage private companies have essentially zero correlation with the ASX or with listed global equities. When the listed markets corrected, as they did sharply in 2022, a well-constructed venture portfolio is not going to move with them. And that's not because venture is safer, it's because the return drivers are completely different. With venture, you're investing into technology adoption curves and company-specific execution, not in interest rate movements or macro sentiment. The second key reason why venture stands alone is the genuine need to diversify. The reality is that as more companies choose to stay private, some of the world's best companies, the most high-growth companies, arguably the most interesting companies, just cannot be accessed on the public markets. There are now in Australia more than twice as many private companies in Australia valued at over $100 million as there are listed ones. In fact, according to JP Morgan, the public markets, the listed markets, are declining at the fastest rate in 25 years, and they're forecast to continue to decline into the near future. And so the public markets today simply do not provide diversified exposure to the true universe of corporate stocks. Even the indexes are now heavily dependent on a few major companies for their performance. Meanwhile, private markets have grown spectacularly over the last 2 decades, and they're forecast to continue to grow to 21 trillion globally by 2030. And when you compare this data side by side, what becomes very clear is that the investment markets are undergoing a massive global shift from public to private assets. And so, if investors want diversified exposure to the true universe of corporate stocks and where the next decade of returns are being built today, venture capital has to be part of your portfolio. And the third reason is return asymmetry. Venture capital operates under what fund managers call power law dynamics. Most investments in a portfolio will underperform or they will fail, but the ones that do perform well, the ones that work, can return 10, 20, 50 times the original investment. And that is very much the intention. So when SpaceX listed last week, retail investors were thrilled with their 20% increase at the end of day one trading. But the venture capital investors who backed SpaceX at the beginning made, in some cases, up to 100 times their money. Even taking examples that you're looking at here from our own portfolio, we've seen companies like EasyCollect deliver a 600% return to investors in about 6 years, which is about 100% IRR. 4D Medical delivering 295% return to investors in only 18 months. Morse Micro, that we currently still hold, which recently raised an institutional round at 500 million VAL, is now backed by major institutional investors and large family offices, including the Turnbulls. But at the time that our investors invested in Morse Micro, it was valued at 40 mil. That's a book value increase of 12.5 times. And there's way more growth to come with this company. It's just getting started. Now, you can't buy Morse Micro shares anymore because they're not listed. And the only way to get access to returns like that is to invest in them privately. There is an asymmetry about venture capital that you can't get anywhere else. And these are not outliers. This is the way venture capital works. It is the model. The asymmetry is not available in listed markets. You cannot buy listed equities and expect these kinds of returns on a single holding because the market has already priced in the upside. But in venture capital, it hasn't. The most dynamic part of the economy, the part that creates the next generation of real wealth, is private. And in our view, a portfolio with no venture capital allocation is simply missing the most important part. Now, the good news is that we live in a country where more unicorns are built per dollar of capital invested than anywhere else in the world. And as the Australian innovation ecosystem continues to get stronger, that rate of growth and success of private companies is only likely to increase. It is also the case that Australian venture capital and private equity consistently outperforms public markets over the medium and long term, according to analysis conducted by Cambridge Associates. So the next generation of high growth companies in AI, in health tech, in climate, in defense, in advanced manufacturing are all being built right now, and they are being built privately. We believe that the next decade will deliver some of the most extraordinary growth in corporate value that we have ever seen, and that the great majority of that value will be generated in private markets. So the question is no longer whether venture capital should be included in a portfolio, but how. In other words, the asset class argument stands on its own even before we get to the tax overlay. But the tax overlay, particularly as of 12th of May this year when the budget announcements were made, has made it very compelling. As I mentioned earlier, the ESVCLP program was introduced by the federal government in 2007. Sorry, Jace, do you want to just click that one more time? No, just go back. Okay, cool. Sorry, guys. There's there's an image missing there. Forgive me. So I mentioned the ESVC program introduced in 2007 with a very specific objective to increase the pool of patient capital available for the commercialization of early stage technology. It is designed to be used essentially by fund managers who are investing into eligible venture capital investments as defined by the tax legislation. And the logic is simple. Venture capital is high risk, long duration asset class, and the government recognised that the standard tax treatment was a genuine disincentive. So they created a structure that is tax exempt at every level. Specifically, just go back, Jace, for me. Thanks. Specifically, there are three tax concessions worth noting. Firstly, when you invest in an ESVCLP, you receive a 10% non-refundable tax offset in the year that you make the investment. Secondly, distributions from the fund, income distributions, are fully exempt from income tax, not concessionally taxed, but completely exempt. And third, capital gains from qualifying investments, companies that are held for more than 12 months, are fully exempt from CGT, zero. No 50% discount, not the old 23.5% effective rate, zero. So for 2 decades, this structure has been used as a specialist tool. Institutional money knew about it, and funds managers in my circle have been using it extensively. But now, because of the budget announcement, this is becoming a mainstream conversation. So the 2026-27 budget contained 2 sets of key changes that are relevant to everybody on this call. First of all, the first set changed the broader CGT framework. The second expanded the ESVCLP program itself. So I want to deal with those 2 things in order. Firstly, the CGT discount's gone. Since 1999, for 25 years, Australian resident investors who are holding an asset for more than 12 months were entitled to a 50% discount on capital gain. For an investor at the top marginal tax rate of 47%, that meant an effective CGT rate of 23.5. That single concession underpinned the after-tax return calculations for property, for shares, for unlisted managed funds, and for standard holding of private shares for a generation of investors. But from 1st of July 2027, it no longer applies. It will be replaced with capital gains, which will be subject to CPI indexation of the cost base, returning to the pre-1999 method, and a 30% minimum tax rate on capital gains, which could be as high as 47%, depending on your tax rate and for larger gains. But when it comes to venture capital, the government was clear. ESVCLP investors are not affected by the CGT reforms at all. The full CGT exemption on qualifying investments remains fully intact. Now think about what that means for the structural comparison. Before the budget, the ESVCLP saved an investor at the top marginal tax rate approximately 23.5 percentage points of CGT relative to most alternatives. But from the 1st of July 2027, that saving increases to at least 30 percentage points and potentially up to 47 percentage points, depending on the size of the gain. The ESVCLP has moved from attractive to structurally unmatched. But the budget didn't just create a structural advantage for existing ESVCLPs, it also expanded the program in the most significant way since its introduction in 3 important ways. But to understand those changes, you first need to understand that under the tax legislation, the ESVCLPs can only invest in certain things. Their investments need to drive a policy objective. And so the concept of eligible venture capital investments becomes relevant. Obviously, government's not just going to hand out tax concessions that are this generous without achieving a very clear public policy objective. And in this case, it is to increase the pool of patient capital into early stage venture innovation. And the definition of eligible venture capital investments is essentially how that policy objective is monitored. It includes things like An ESVCLP must invest in things that are at risk. An ESVCLP can only invest in permitted securities, which are typically equity instruments rather than debt instruments, although there are some exemptions. An ESVCLP can't invest in listed companies or pre-owned securities, although there are some exemptions. It can't invest any more than 30% of its committed capital into any one company to avoid portfolio concentration. 80% of its capital must be invested in Australian companies at the time the first investment is made. And there are a number of other rules. But there were three important expansionary changes that were announced in the recent budget that now allow ESVCLPs to do more and that provide a significantly greater benefit for investors than previously. The first is that the maximum fund size has now increased from 200 to 270 million. This is good for our most ambitious fund managers, which means they can raise larger funds. It's less relevant directly to investors, although it does help for fund managers to have the availability of more committed capital to be able to follow on in investments in that vintage that are doing really well. Secondly, ESVCLPs can now invest in larger, more advanced companies. Previously, they could only invest in companies with total assets of 50 million, which kind of capped the size at which you could make an initial investment. That cap has now grown from 50 mil to 80 mil at the time of the initial investment. And what this means is ESVCLPs can now back companies at a slightly larger, later stage of development without losing any of the tax concessions. And then finally, the tax-free concessions applied in respect of a company to a certain point, right? Usually these companies are invested in it at a very early stage where they're worth very little. The tax concession applied up until the point that they were worth 250 million. That cap has now been increased to 420 million. That is a very clear sign that the government intends for this program to operate at a much greater scale. The political signal here is as important as the technical one. The program has been endorsed and expanded at the same time as the broader CGT concessions have been removed. The government is telling you very clearly where it wants capital to flow. And I say, take advantage of that opportunity. So, as I said before, the next generation of truly high-growth companies in AI, in health tech, climate, defence, advanced manufacturing are all being built right now, and they are being built privately. The next decade will deliver some of the most extraordinary growth we've ever seen in corporates, and the majority of that value will be built in private companies. So the question is no longer whether VC should be included in your portfolio, but how. Now, there are obviously lots of different ways you can do that. But certainly I think the most compelling option right now, unless you are a sophisticated enough investor with venture capital experience to be able to run the ruler over hundreds of deals yourself and conduct due diligence at that level of sophistication, my view would be the best way to dip your toe in the water and add venture capital to your portfolio fast is through an ESVCLP managed by a credible manager. Now, one of the biggest challenges in adding VC to a portfolio, though, has always been access. Historically, direct investment into most VC funds requires a minimum of $250,000 or more. Now, that placed the asset class well beyond the reach of most investors, even wholesale investors, for whom that 250 minimum is a significant position in a single fund. Most advisors weren't even having the conversation because that entry point made portfolio level allocation impractical. And this is one of the issues that we've been focused on addressing. And now, by investing in a fund via VentureCrowd, wholesale investors can access funds like the Sydney Angels Sidecar Fund, that I'll tell you more about in a minute, for a minimum total commitment of only $25,000. And in that case, the commitment is then called in 5 equal annual installments, which basically means you can add venture capital to a portfolio for as little as $5,000 now. I'm just going to move on a little bit, Jace, because of the time, and move on to the Sydney Angels Sidecar Fund parts. Yeah, thank you. So for those of you who are interested in adding VC to your portfolios or those of your clients in a highly tax efficient manner without over-committing, I invite you to take a look at the Sydney Angels Sidecar Fund 3. This fund co-invests alongside Sydney Angels syndicates, where the deal screening and the assessment process has been done by Sydney Angels syndicates using a due diligence process that has been developed over a decade by some of Australia's leading angel investors. And it's led to some of the largest venture capital returns in the country in recent years, including the exit of Clarity Pharmaceuticals that delivered a return of 50 times return for investors. This fund has been extremely popular, and since when we launched it, it reached its tranche one target in the first hour and was 350% oversubscribed in the first week. Since then, the fund has invested in 6 exceptional Australian companies, including Meritech, II Shield, and Axiom, and a number of others. And a number of these companies are performing so well that investors, I think, just will never get access to them in any other way again, because future raises are likely to be taken up entirely by existing investors. So if you want access to companies like that, those companies specifically, the Sydney Angels Cycle Fund is now the only way to do it. This fund has over 140 investors in it today, and we've just opened a final tranche of investment with a minimum commitment of $25,000, which will be called in 5 equal annual installments, which means, as I said before, you can add venture capital to a portfolio for as little as $5,000 today. And also, as I said, this is very much by design. We want to make it possible for as many people as possible, as many new investors as possible, who we know have a big interest in innovation, in startups, in the technology sector in Australia, and participating in venture, to be able to do that as conveniently as possible. And the government has just made that proposition materially more compelling. Now, we're coming to the end of the webinar. Jason's going to bring up a poll in a moment, because we know many of you are going to want to know a lot more about some of the information that you have heard. Do use this opportunity to let us know if you'd like to know more about establishing an ESVCLP, which we can help you do, the Sydney Angels Sidecar Fund 3, or if you're a financial advisor, we are running a series of private briefings at your offices for you and your partners to discuss all of this in more detail. So if that's of interest, just let us know using this poll, and one of our team members will be in touch with you tomorrow to continue the conversation. In relation to the Sydney Angels Sidecar Fund, it genuinely has been very popular. We will be making allocations on a first in, first served basis. So do let us know here if you're interested in participating, and we can be in touch tomorrow with more information. That is all the time we have today. I hope that content has been useful. I'm going to hand back to Jace now to close out.
Thank you, Steve, and thank you to all those that have attended. If you do have any questions, please reach out on either 1300 039 655, or you can email investor@venturecrowd.com.au as well. We'll also be sending the recording of the web investor update component of this webinar to all investors within the next few days as well, most likely by tomorrow. Thank you very much again to everybody that attended. Have a great afternoon.
Thanks, Jace. Bye, everybody.